My apologies, my apologies, my apologies, my sincere apologies. I have no idea why this has to happen. My sincere apologies. I think it should be nice and good. My apologies, my apologies, my apologies. Good. My sincere apologies. I have no idea. Okay, so I think we're good. So I want to believe you're ready to kick ass. I'm about to teach you some really good stuff. So it's just really unfortunate. I just wanted to jump right in and then get this thing started, right? So without having to, because I have no plans to, I have no plans to, try to come back to this video, to do any form of editing. So I just wanted it to go, just go straight in and then show you what I have to show you. But it is what it is. I'm going to move on from here. Okay, so I have my WhatsApp is open for those of you who are on my private mentorship, and my Telegram is equally open for all of you guys who would like to connect with me while I am giving you the presentation. What I want to teach you today is what I want to teach you is market structure. Market structure, okay, and market structure is something that I think many of you are already very familiar with, okay, because there's nothing hidden about market structure. The only thing that is hidden is whether you're learning from the right person and whether you're making money with it. Okay, because I always say that if you're trading and you're using a particular concept, but you keep getting stopped out, then you are doing something wrong, right? There's no other way to say it, right? If you're not making money, if you're trying to trade with the market structure and you are not making money, then sure, then you're not doing something right. Okay, so let me see what I can do for you. And I'm not going to be surprised if you don't get this thing the first time around, because this is not it's very simple, right? It's very simple, but it's going to take time for your eyes to recognize it, perfectly. So you're going to need to come back to this presentation, time and again, right? You're going to have to keep coming back to see what I talked about, as you do your back testing, as you go over, your trading examples. I'm going to try to see if I can give you maybe an assignment or two so that you can go back and do something, right? So regardless of who you are, what you're doing, what you're learning, who is teaching you, whatever method you're doing, if you understand market structure, you understand whether the market is moving up or down, you understand whether the market is consolidating, you understand where the market is at every point in time. That's the essence of the subject. I'm not going to bore you with all the Wikipedia's definition of all those things. I don't care about all those stuff, right? What I'm interested in doing is showing you what you're going to use to make money. Let me show you what I'm talking about real quick. You know that, as much as I do, that Dow proposed in the early days. What I'm teaching you is market structure, and as you can see, I'm sure you're not surprised. I do not have any presentation whatsoever for you here, okay? Because what I'm going to teach you from my stomach is exactly how the prices move, okay? And I want to let you know that if you can, if someone can show you these things from the top of his head, right? Just off of the top of his head, without, it means that it is something that anybody can learn. Okay, I always say that, see all the big athletes, you know how much effort they have to put in before they get to the stage where they become they start to earn millions. Traders want to earn like the footballers are earning. They want to earn like all these people in the world, right? All these top athletes. Okay, but you're going to be willing to put the work. If you cannot put the work in, if you can't put the work in, you cannot make the kind of money that they can make. There's no shortcut in life, right? There's no shortcut. It's either you go hard or you go home. Okay, so this is what Dow proposed. When I say Dow, I'm sure you know of the famous Dow theory. This is something I teach, a long time ago, right? Where he talked about a low, high, and then as this thing starts to progress, you have a low that is higher. So it's called a higher low. All right, and then you have a high that is higher, which is a new high. Okay, so the new high is referred to as the higher high. Don't be so quick to run away, because what I'm going to teach you here today is nowhere near what I'm drawing on the screen already, right? I'm going to teach you deep stuff, right? That's going to help you to look at any market, right? You just need to apply the principle to any market, to any screen whatsoever. I beg your pardon for my dog, man. I'm going to need them to take her outside. So you can pretty much use the concept of market structure to trade any particular pair. Okay, so what happens? The market pushes back, and then it makes a new high, right? Makes a new high. We still say, okay, the new high is a higher high. The low that was made is a higher low. So what do you see? What you see is an uptrend. Okay, and how can you make money? How can you make money in this in this move, right? The best way that you can make money is if you're able to spot the beginning of the trend, that early stage of the trend, right? This first move, right? If you can spot that this guy here, oh goodness gracious. Okay, sorry about that. So if you can spot, I think there's someone there. That's why the dog is barking. So if you can spot that this is the beginning of a reversal, right? If you have something that's going to show you, you can read the market to the point where you say this leg, this particular move that I have circled with the dotted lines, if you can tell yourself that this guy here is the beginning of the move, it's going to save you a lot, right? Because you can easily join the move where at the base, right? At the base, if you miss the first one, you're going to have another opportunity to join, right? When the market comes back, it comes back to where? To this area here. So traders are looking for opportunities to get in here for a new move, right? And then again, if you miss the first one, you miss the second one, you still have the final chance. I call it the final chance because what you see, which traders do not know, is that when this thing happens 3 times, there's a high chance of a total reversal because you now have a lot of liquidity here. You have a lot of money sitting here. So if you're not able to get the first one, try to get the second one. If you're not able to get the second one, try to get the third one. If you miss the third one, it becomes really, really, really risky for you to try to catch another one because it's never going to go up forever and it's never going to come down forever. Okay? So what I'm saying is I've not started teaching you anything yet. This is just a periphery, and I don't want to waste a lot of time with the theory, but there's a lot of theory around this. Okay, so what you see here is order flow. What you see here is what's it called? Continuous. This is an uptrend. Okay, this is an uptrend. This is an uptrend. What you see here is that the demand is holding. Okay, so demand is holding, supply is failing. Demand is at the base, right? Demand is at the base. Demand is holding, supply is failing. Demand, these are all demand. This up here is support. When I say demand, think about support, right? When I say demand, think about support. When I say supply, think about resistance. Okay, but we call it supply for a reason, and I'm not going to go into that in this class because that is a whole new topic on its own. But just know that the supply is the area where we think that the market is overpriced. Okay, so there's a discount that's given, and then demand is the area where the supply, the availability of the product is lower. So there is a lot of demand for it, right? The price is cheap. So there's a lot of demand, so people going to buy, and when they start buying, that buying activity going to push the price higher. Okay, going to push the price higher, and then supply will kick it down. Okay, so supply is there to kick it down, demand is there to take it up. Supply is there to kick it down, demand is there to take it up, until we see a complete reversal that takes away all the stop losses that have been queued up here, if they've not been taking their profits, or if they're not out of the market yet, right? So what I'm showing you is just an introduction. So your goal is, when the market starts, you want to buy, somewhere here, right? From here to here, you have an opportunity of looking to take an entry somewhere inside here, and then when you get that nice entry, you want to buy again. Okay, so just for the sake of those of you who are taking good notes, I'm going to define some things which are very, very important for you to understand. It's easy. You know what a high is. A high is the first point on that first leg, right? The highest point on the first leg of the every trend will start with a high and a low, right? What's going to be the high in an uptrend? There's something traders call change of character. Change of character is the area where the market turns from either bullish to bearish, or bearish to bullish. So what we're saying is, if there's a complete change of trend, we now say that there is the first leg is the high, and then the lowest point there is the low, right? So the high is after a change of character. I'm going to use these words because is what is popular, so that I don't confuse you. All right, this is what is popular, so that you don't feel like, oh, what's this, what's that. Okay, so that's what they refer to it as. But for me, what is important is the concept. Okay, not the grammar. I always say that technical analysis is just a marketing gimmick, right? Is just they do all these beautiful things on the charts as if they are doing Photoshop, right? They do all these lovely things to lure you to think that this person knows what he's doing, just to get your attention, right? So the main thing is whether you're making money. If you're not making money, then it makes no sense. All right. So, and then what will be the low? Of course, the low is going to be the lowest point, the origin of the trend, right? The origin of that move. So that's the low. And then what's the higher high? You know what the higher high is? It's a new high. Okay, it's a new high. And then this is for an uptrend. Then the higher low is the new low. Okay, is the new low. Right, I'm gonna come back to all of these things. I'm just sharing these things because I'm going somewhere, right? I'm going somewhere. I'm going to start to use these terms, lavishly very soon. Okay, so Another thing that traders might want to know is what we call a swing structure. A swing structure is the main trend. I'm going to need more room, so I shall add another page. So there's something called the swing structure. There's something called the swing structure. There's something called the substructure. There's something called the swing structure. There's something called the substructure. There's something called the minor structure. Okay, so don't worry. It's not difficult. I'm just labeling those lines that I drew, right? If this is the move to the upside, and this is the pullback, right? We're going to have what? Another move to the upside. That's what I just labeled. Okay, so there's nothing to confuse you there. So this is the swing structure, right? That's the swing structure. So this is your swing structure. This one here is your swing structure. This one, right? That's your swing structure. Okay, so if this is a swing structure, it means that the low here is called the swing low. Okay, take note of that. The high here is called the swing high. Those points are important, right? Because we're going to start looking at the market soon, and then we're going to start saying, oh, is the swing high still there, or it has been taken out? And that's when we now say, oh, there's a break of structure. Okay, for a continuation, I'm going to show you more information, and I have deliberately made the pullback, look like this. We call it fractals, right? This pullback here, that pullback is called the substructure. It's called the substructure. Okay, so without anybody telling you, you can very simply see that it can be called, the corrective structure. The corrective structure, right? Or you can just simply call it the pullback or the retracement, right? Now, what you need to know here, you can see that what I'm teaching you is the basics, is the foundation of trading. This is the beginning of Forex trading. Okay, but if your foundation is bad, you build a tower, a tower with the wrong foundation. You know how many months they spend if you want to build a skyscraper, you're going to spend a long time doing the foundation, right? You're going to spend time, digging and getting to the layer of the soil where you are sure that is the base. The civil engineers know what I'm talking about. You get to the level of that, the ground, where you know that you have gotten to the hard part of the ground, right? Where you can start to cast from. So it's like you're casting it along with the casting of the earth, something like that, right? You start casting from there, right, to build the tower, right? Imagine if your foundation is bad, right? You use poor cement, you use you don't use good rod, bad foundation, and you start to build the tower. The tower will look good, it will keep going. It will keep going. Before you know it, it's going to crash. Right? So you can make some money. You're just being lucky because your foundation is bad. So after some time, what's going to happen? You're going to crash, right? It's going to happen to you. Okay, so it's important to, the novice part of trading is one part of trading that a lot of traders skip because of how easy it is for you to go straight into the laboratory. It's easy for you to go straight into. See, a medical student, I can't just teach you how to stitch, cut a body open and do some surgical process and stitch, just stitch it, and then you go into the OR and then you try to cut somebody open and then you stitch. You're going to kill somebody. But that's what traders do. They don't learn. These guys will learn for 4 years and 4 years if you're schooling abroad. If you're schooling areas like my country, you go for 6 years, and then you do an internship before you can cut somebody open, right? So you don't come to trading and then you skip the novice part and then you go straight into the OR to cut somebody open because you can buy and sell with your phone. It's wrong. Where are you rushing to? You're going to waste your money, and I'm going to take your money, right? I'll take your money because the traders who have spent more time, who are more experienced, they are taking your money. Okay, I always say the MT4 is just an app. It does not print money, it doesn't generate money. The money you're trying to take is deposited by somebody else. The money you're trying to take from that MT4 app, MT5 app, whatever you're using, CTrader, the money you want to take there was deposited into the broker, was deposited into the prop firm. It's not the app that generated it. It's someone else's money you want to take. The broker will put them together. Anybody who wins, the broker will send the money to the person. So if you go there, you're unprepared. You go there, you don't have a coach. You don't know what you're doing. You don't even understand market structure, right? You go in there, they're gonna take your money. There's no two ways about it, right? Because some people know this and they have a mental edge. They're gonna take your money every day, right? You see profit and then you start to shake, right? You want to take it out. There are people who don't care. They will stay there. That profit will reverse. They are not bothered because when it will go, they will make a lot of money and cover up for their losses, right? They have mental edge, right? So these are some of the things. So sorry for digressing. I really, really want to keep this thing below 1 hour maybe. Hopefully. Okay, so yeah, this is the substructure, this is the corrective structure, and all these names are the same. Okay, they are telling you that the market is retracing, the market is resting, the market is pulling back, and they are characterized by mixed bars. So here you see, if we're going up, you're going to see a lot of green bars on the way up. When we're coming back, you're going to see red bars. If your chart is green and red, so you're going to see red bars, a lot of red bars, okay? Mixture of red and green and red and green and red and green and red. That's if you're measuring pressure, you can easily see that there's a mixture of bars on the pullback and there is just there's mostly one bar, one type of bar on the way up, right? So that tells you firsthand that you're dealing with the impulse leg. The swing structure, of course, is the impulse leg, right? Is the impulse move. You know what impulse means? Physics, right? Impulse, right? It means, just think about something like surge, right? Something that moves fast, something that goes, actually, moving with intention, right? So there you have it. Swing structure, impulse leg, whatever you want to call it, right? This is the guys that have the market. This is a mixture of both, but it's pulling back. It's pulling back to where? To a discounted area, right? To a discounted area, okay? To a cheap area. And then there's actually a reason behind this. We say that there's a big bank, the guys who are actually moving the money. What they do is when they start, they push the market up, they buy. When they buy, they don't have stop losses. When they buy, they sell. They have enough money to move the market. That's the assumption. That's the logic they gave us. They have the money to move the market. So they buy. When they buy, they want to cause an uptrend, right? They're going to buy. When they buy, they will induce you to think that they are buying. Now, a lot of people will not buy early. They're not going to buy at the early stage, right? At the discounted area. They're not going to buy here. When are they going to buy? They're going to buy when it's obvious that the market is buying, right? Once that happens, what is happening now? Their stop losses have been queued down here because they are all buying at the top. Now, what this guy is going to do, They are the ones that bought this market here. They are going to now sell the market so that they can pack all the money that is here. Okay, so when they sell the market down, they will sell it to the area where they initially bought from. Now, when they sell back to the area where they initially bought from, they are now going to close this first position, right? So they will close the first position that they started with. But mind you, they have taken away all the stop losses of everybody that tried to buy at the up area. Okay, so they take away all those stop losses. Of course, with this retracement, right? They take away the stop loss. What do they do again? They are going to now these people will give up. Okay, they're going to give up and say, oh, I'm wrong, right? So what do you know? They've closed their position. They're going to push the market again up, right? They're going to push the market again up. The people who are seeing this pullback now, who think, oh, the market is now in a sell, right? And then they all keep their stop losses here. Okay, the market is in a sell. What's going to happen to them? The resumption of the trend going to stop them all out. Okay, going to stop all of them out. And then when it stops all of them, by the time they join, they flip their positions from selling to buying. But buying at what area? Here, up here. That's where they're buying, right? They're buying here, but no, it's late. Okay, because these guys are going to do a retracement back to the area where they got in from to close that position. Take away all your stop losses. Those who don't use stop loss, they are doomed, right? Because the market can just go all the way down, take this thing out, and either push up or even do what we call a change of character and then push down. So it can continue and continue all the way down till you are not part of the traders who show up the next day, right? Because it's going to keep going until the margin call is given. Okay, that's when you see that your account has been smoked. And what has just happened to you? A smarter trader has taken your money. That's what happened to you. A smarter trader has taken your money. So what should your goal be? What should your goal be? Your goal is when you open your chart and the market is going up like this, your goal is to look for a way to get in when you see this impulse leg. You're not chasing it. You're waiting. When you get the impulse leg, you're not chasing it. You're not chasing it. You're waiting for it to come back down to somewhere around here where you have demand, right? You're waiting for it to come back down to somewhere around here. Then this is where you join. So you join them with that game they are playing. You join them, right? That's how you're going to make money. Okay, and then this is why I teach. One of the things I always teach my mentees is a 3 RR, because it's very possible, right? It's very possible. 5 RR is very possible, right? If you can get in early, right? If you can get in early from an area of pullback, the trend is up, and you can get in, somewhere at the base here, your stop loss is going to be just maybe 10 pips, right? 10 pips. And then you're going to go all the way back to this point for about 50 pips. That's 1:5. If you risk $1,000, you're making $5,000, right? And I teach this. I say if you have a 1:5 RR and you're making 1:R, if you place 10 trades, and you lose 7 trades, right? You lose 7 trades, you win 3 trades. You're going to be up 8%. 7 trades is going to give you -7. 3 trades is going to give you +15. What's this going to give you? 8%. 8% profit. This is 10 losses. 10 losses, 3 wins. 8%. Right? 8%. That's a lot. Okay, that's a lot. So all you just going to make sure you do is executing your strategy correctly. So what I'm going to teach you today is how to correctly read the structure. Okay, how to correctly read the structure. And I'm running out of time already, so I'm going to beg your pardon if I'm too fast. Just come back to the video and take the information again at your own pace. Okay, so this is the goal, guys. This is the goal. This is the goal. This is the goal, right? Market's pulling back. It goes up, right? Now see what happens. First thing here is what we call this. So once the market breaks this point, we call it what? A break of structure. Okay, I'm using the normal term that is popular for everyone to understand. This is called the break of structure. That's the first thing that happened, the break of structure. Now, the way I teach a valid break of structure is very different from most people I see, because there has to be intention. There has to be intention. The guys who are moving money are not going to move the money unless they have taken some form of liquidity. What I mean by liquidity is if they have not taken stops where the obvious areas where people would have kept their stops, they are not going to move the market higher, right? So what makes your structure valid is that your swing structure, what makes it valid is that stops have been taken. I just remembered something. My goodness, I'm sorry. So I mentioned the swing structure being this one. I mentioned the substructure. The minor structure is just the one that is taking you back up. Okay, so this one that is taking you back up is the minor structure. Minor structure will usually turn to a major structure. Okay, it will usually turn to a major structure, and I'm sure you can see what I just wrote here, right? This is the minor structure, right? So this leg that is sending you back in the same direction with the swing structure, that is the minor structure. Now, one thing you need to understand is everything that happens inside of the swing leg. If this is the swing up, this is the pullback, and this is the resumption, right? This is swing structure. This is substructure or internal structure, right? Or corrective structure or retracement or pullback. And then this is minor structure until it breaks out here. It now becomes the new swing structure, right? So everything that happens inside here is called internal structure. Everything that happens inside here is called the internal structure. And then from here to here is called external structure, guys. External structure. Okay, so I'm sorry about that. I just remembered that I have skipped that. Okay, so this is what happens, right? Once there's a break of structure, once you see that this level has been taken, what do you expect? You expect what? A reversal. If you're good, if you know what you're doing, you can go to a lower time frame and look for a reversal pattern, and then you join them in the reversal. Okay, but you have to be sure that you know where the reversal is going to get to, so that you can change your position back to an uptrend. So this is a traditional way that people draw the structure, but that's not usually how I like to look at structure, right? Because I want to see that there is an inducement, engineering liquidity before the market pushes. Okay, so I want to see the market take some form of liquidity before it goes. I want to see the market take some form of liquidity before it goes. Okay, I'm not teaching you entry in this particular. In fact, I don't even know if I'm going to be able to cover the structure, right? Because of time. I don't know if I'm going to cover structure, but I think I'm going to go as far as you should be able to use. So your job here is, once you see a break of structure, once the high is captured, you're looking for in the lower time frame, right? and I'm gonna show you the refreshment. I'm gonna show you the relationship between these time frames. Okay, so let me do this. If this is the higher time frame, the lower time frame is I'm looking for approximately 20 bars. Okay, so if I have weekly, if I have weekly, my lower time frame going to be H4. If I have daily, that's 1 day, my lower time frame going to be H1. If I have H4, my lower time frame going to be M15. If I have H1, my lower time frame going to be M5. If I have M15, I have approximately 15 bars at M1, right? If you're using M30, then M2. Okay, so the what I'm saying here is very simple. If once the market breaks the high, right, this high is broken, you all, this is from here to here, right, is the higher time frame, right? So you go to the lower time frame to look for a reversal, and I'm going to show you what that reversal should look like now. So you look for a reversal in the lower time frame, okay, so that you can, what we call a reversal is you want to see what we call a change of character on the lower time frame. So your call as at this area, right, as at so there are some concepts I'm going to show you, and then I can very correctly tell you when you can take your call. So your call is either that the market is going up or going down, or it is, flat. So some things to bear in mind, right, is that there's something we call a gap. There's something we call a gap. Okay, and I'm going to talk about this in the subsequent classes. See, just take note and assume you understand what I'm saying. See, a gap is that these bars, these bars, we call them gapping bars if they are like strong trend bars, right? And there's no overlapping of wicks, right? See what I just added, assuming it's not there. If that thing is not there, it's called gap. Okay, they are called gapping bars, right? So assuming that thing is not there, you can say that they are gapping. All right. So that being said, so you can see I just removed them. So imagine that the wick is just small like this one is small like this, so you can see that there are some spaces. So a gap is the first bar, right? If there's a space between the high of the first bar and the low of the third bar, right? From the high of the first bar to the low of the third bar, there's a gap. Okay, so that is important, because it's going to tell you that really there is intention here. Intention meaning that there is an intention for what? A surge. That there is a surge, an impulse, a forceful move. That's what I'm saying, a forceful move. There is a lot of push when you see a gap like this, right? So that's one thing to take note of. This is bar 1, this is bar 2, this is bar 3. From bar 1, see bar 1 here, 1, this is bar 2, this is bar 3. The high of bar 1 is here, the low of bar 2 is here. From here to here, there is a gap. This gap is called, they usually call it, I think ICT guys say FVG, that's fair value gap. But what you just need to understand is that there is an imbalance, right? There is an imbalance. If you go to other time frames, you will just see that maybe This one bar 123 is just, you know, a single bar, right? There's a gap. So the market has a strong momentum to go up. Okay, it doesn't have time to come back, fill up the gap before it goes. So it's in a hurry to go up because of the big orders that have been placed, right? So just leave some part of that there. Okay. My apologies. I just used the shortcut for that. I'm gonna go into the chat real soon. Okay. When I go into the chat, everything I say here will become maybe a little less vague. So for you to take your calls, right? For you to take your call, are we buying today? Are we selling today? Are we in a trend, right? Or in a range, right? You want to check if there is a gap, right? We call this it's called the fair value gap, right? You want to see if there is a gap at the base, right? At the base, gap at the base. Okay, so gap at the base, meaning at the lower area. Is there a gap to be filled? Because the market is naturally supposed to come back and fill it up. Okay, the market is supposed to come back and fill up this gap, right? So is there a gap for the market to fill? That's one question to ask. Okay, do we have up to a 50% pullback, right? Do we have up to a 50% pullback? That's another question to ask. So if the market goes up and then is coming back, if it is less than 50%, you're waiting until it gets to 50%. So if see what I'm saying with this, see where I'm going to. We have market go up, market come down, and the market goes up again. See, from the point where market gets to this high, right? This is when you define that we have an uptrend. When that high is broken, with the body of the candle, not the wick, with the body. You see a candle body that closes. Even if a wick appears, the next one has a body that closed above it. Then you can now say that the market has is in an uptrend. Now, when this thing starts to go up like this, your work now is, how can I enter at this place? That's your work, right? That's what you're looking for. How can I enter at this place? Since we are in an uptrend, I don't want to buy here. I have to wait until the market comes down here. Then I will look for a way to join it and buy. Now, so mind you, once this is going on, your call is that the market is in an uptrend, right? It's in an uptrend. Once this is going on, as long as you have an established trend, right? When the minor trend resumes, you know that the market is in an uptrend. Now you get to the point at this area where you can say, okay, I'm going to go to the lower time frame, right, to see if the market is trying to retrace. It's going to start with the lower time frame. Every move begins in the lower time frame, right? So you're going to see it early in the lower time frame that is now pulling back. Now, once the lower time frame confirms that is beginning to pull back, your call is down, right? Your call is down. The question now is, are you willing to trade the downside, or you want to wait until the trend resumes? Because this thing can resume at any time. This thing can come here and resume. It can come here and resume. It can even sweep the low here and resume. Right? So you don't know if or what will happen. Right? You don't know if it will happen or what will happen. So usually the best thing, excuse me guys, I believe that the dog's barking is getting into my headset, so I want to believe you can hear it as well. So I have to ask them to take her out of the cage. Okay, guys, sorry about that. So you have a 50%. Well, where was I, please? So yeah. So two things, right? As long as you're pulling back and you don't have up to a 50% pullback and there's a fair value gap, you can call a down, right? Meaning that if you're trying to trade in the lower time frame, your bias is that the market is in a downtrend. Okay, the market is going down. The market will continue to stay that way until it fills up a gap around here, if there is a gap. That's how you can read the bias. Okay, so the question is there a gap down here, right, that the market needs to fill? If yes, then when this pullback starts to happen, you say that the direction of the market is in a downtrend, but you know that this is a pullback and it is only a correction. The major trend can start at any time. So if you're trading that, you have to keep your targets very short, very short. Okay, so I do not recommend it because it's going to take a lot. Even personally, right, it took me a long time before I'm able to join the pullback guys, right? And then the trade management for my pullbacks are different even up to now, right? I'm breaking even real fast. I'm trying to make sure that I'm taking out some money. Okay, except I am in the direction of the trend, right? So I'm holding because I know that this is the trend, and if I'm right about that entry, it's supposed to go all the way. Okay, so that being said, how do you know? So I want to believe you understand the essence of this area here. I'm discussing, whether it's going up, it's going down, it's flat. It's flat is, you're opening the chart and right before your eyes, the market is at the place where you're not sure if is going to go up or down. Is somewhere between, it's just around the internal structure area. Internal structure, remember I told you that everything happening inside the swing area is called internal structure. If the internal structure is not clear, then you can say the market is ranging. You don't know what to do. You do not trade, right? But if the market breaks it, right? Once the market breaks it, you have what? You have an uptrend. And then you continue to call an uptrend until there is a turn in the lower time frame for you to sell. Then you call it downtrend as long as there's an area here to be filled. When the market gets to that area, you know that the downtrend is over. Now the market is going to resume. Now you want the market to resume, you immediately the minor structure begins, you call what? An uptrend, because you know the market is going to head up. And you continue to do this, okay? You continue to do that. And then you take, if you have setups that says, I want to trade only when the market is buying, this is how you're going to join. You have setups that say, I want to trade only when the market is selling, this is how you're going to join, right? So this is the basics. This is everything I'm teaching you up to now is still basics. Even the next slide I'm going to teach you is basics, real basics. When you're going to get serious is when I start to introduce inducement, engineering, liquidity. That's when you're going to see real work. And that's what's going to use to answer every question on the chart. That's what's going to tell you where your POI going to be, where whether you're going to use the gap, whether you're going to use the order flow, whether you're going to use the what's it called, the order block, right? Which one are you going to use, right? Whether the POI is valid or it's not valid, those things I'm going to show you in the subsequent slides. Hopefully, if we have time, right, we have less than 10 minutes. Okay, I have to keep going because I want to get to something that I think will help you. So I'm still using the very, very shabby look, right? Very shabby look. So what I want to show you is what's a valid change of character, right? What's a valid change of character? A valid change of character is assuming that I've been talking about the higher time frame since. Now I'm talking about the lower time frame, right? This is the lower time frame. Okay, so in the lower time frame, let's say if your higher time frame is 4 hours, right, and there's been a break of structure on your higher time frame, right? There's been a break of structure. Now, when you come to your M15, right? If you come to M15, from here to here, all of this all of this, right? All of this is going to be represented by all of this, right? So you're going to see a lot of uptrend, downtrend, uptrend. All of them is just this leg only, right? And then maybe the break of structure will happen somewhere here, right? Something like that. Okay, so you're going to have like something like this. Okay, now what we're now saying is, how do you know that this uptrend is going to stop? When you see a change of character here, right? Because and then let me tell you this. Everything I say, everything I teach you is the real thing based on historic data. Doesn't mean that anything is guaranteed, guys. See, I'm heavy on money management. I'm heavy on risk management. I'm heavy on trade management. I'm heavy on psychology. I'm heavy on mental edge. I know everything about technical analysis, but I am not heavy. I'm not a fan of TA. I know TA because I need to get an edge. I need to get something that's going to push the odds in my favor. That's going to push the luck in my favor, right? Because outcomes is based on luck. You can take an entry and then you get to target. Okay, you can take an entry and then you hit SL. That one does not depend on me. I've done my own part, which is TA. What's going to increase my chances of getting to target is the TA, the work that I put in, the skills that I have. What's going to help me to hold the trade to target is my psychology, my ability to handle fear. What's going to stop me from over trading, opening the chart and then you're buying every bar, you're selling every bar, is my psychology, my mental edge. What's going to make me to stay and wait until the market comes to where I want it to get to? My mental edge. What's going to make me to see that the market has taken my SL and I don't start to trade, forcefully? My mental edge. That's why I tell you, if you don't have these things, another trader who has it going to take all your money. Okay, because he understands the game better than you do. You're just trading like a baby. You're trading your emotions, right? You're just, you're buying and selling anyhow, right? You're letting the market emotional manipulation to get the best of you, right? Because market is designed to manipulate emotion, right? So when you give into it, it's going to take all your money. It won't spare a dollar, right? So what we're saying here is, see, if you look at this, what do you have here? High, low, low and the high, right? So you have the high, you have the higher low, you have the higher high, higher low, higher high, higher low. This is what it looks like, guys. This is what it looks like. Higher high, higher low. Then you have this higher high. Now, instead of the market to come to this area and mitigate your gap or whatever, your order flow, order block, and continue as you expect, what happens? The market breaks. So this level gets broken. This is what traders call a change of character. That's what traders call a change of character, right? This is what is going to signify that this, our higher time frame here, right? It's going to signify that this, our higher time frame, is about to reverse. And then you can now look for gaps here, entries here, as long as you have an inducement or an engineering liquidity and a gap or an order flow or an order block, whichever is closest to the engineering liquidity or inducement, then you can take a sell for the continuation of a downtrend. That's what it is, guys. Because what the H4 is about to, if this is H4, that place, I don't have enough room. If this is the H4, right? Remember I told you that everything here is this, right? On the H4. Now, okay, not this yet, right? Let me make the picture more complete. So this is your H4 or up, impulse move, corrective move, and then you have new impulse move, right? And I told you that everything here, right? Everything here is the same as this on the higher time frame. This is lower time frame, like 15 minutes, and this is higher time frame, like H4. Now I said, when the structure gets broken, what do you expect to happen? A pullback, right? A pullback. What is gonna determine the beginning of the pullback? This gonna determine the beginning of the pullback. We don't expect the major man here to be broken. We don't expect the major man here to be broken. If he gets broken, then it's called a change of character or a break of market structure, whatever you want to call it, or a market structure shift, right? So you can see early that, oh, the structure that was holding is not holding anymore. So how can I join? If I cannot join on the first leg, how can I join on the second leg, on the pullback? But you are looking at this pullback and you are observing your H4 for the area of that impulsive leg resumption. So what do you do again? When the market gets to the area where what we refer to as the point of interest, POI, right? Point of interest is the area where you are interested in buying from. What do you want to see again? You want to see another break of structure, right? You want to see another break of structure so that this structure is broken. So we now call this what? Change of character. On this change of character, guys, you want to buy. Once the market gives you a pullback, you are buying. Once the market gives you a pullback, you're buying, right? The market goes up, 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 up like this. It keeps going. Once it breaks, this level is broken, right? What do you want to see? A pullback. And then what? Entry, buy, sell in this case, right? Sell. Market pulls back, come back to this area, somewhere here, 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 50% deep or even deeper, right? Sell. Market starts to come 10%, 20% not interested, 30% not interested, 40%, it catches my attention. I label this area as a lower low, right? And I'm waiting for what? For a POI to be mitigated. Once the POI is mitigated here, what do I want to do? I want to sell. Do I continue selling here? No, that's stupid. What do you want? You want the market to come 10, 20, 30, 40. Interesting. 40 takes your interest, right? That's about 38.2. That's what they call it, but I prefer 40, right? So from 40, I'm now interested, but I'm not going to join them at 40, right? Because I want it to come in deeper so that I can get my 5RR or 3RR. So come in a little bit deeper, then mitigate my other flow or other block or fair value gap, anything, as long as you have an engineering liquidity or an inducement. Mitigate it, take all their stops, and continue. That's what I want to do. I'm going to do it over and over and over and over and over again. Okay. So this is just the introduction. This is just the introduction. Everything I'm saying up to now is the introduction. I'm really sorry if you're beginning to find it difficult, but this is the introduction and it's not difficult. When I open the chat, you're going to see what I'm saying. And unfortunately, I'll not be doing that today. So I will do that another day. All right. I'm going to show you another day. But before I go there, I'm going to show you something now. Something very important. Now, see, a lot of people make a lot of mistakes. On the way up and on the way down, if the market has not given you something that makes you think that there's a liquidity that has been taken, right? It's wrong. Some people come here and say this is a break of structure. No, this is no break of structure because this is not valid. This is only an extension. This is no break of structure. What is a break of structure? I want to see what? An inducement. I want to see an inducement. This is an inducement. Inducement is what? Induce people to think that there is going to be a buying here. Induce them to think that there's going to be a buying here. Those people who are going to think that, oh, this is a break of structure, then, well, let's buy here. Induce them. Take away their stop. When you induce them, take away their stop, go to a higher level. Now I know that I have a solid swing structure. All of this is not structure. This is the first structure here. First structure. Why? Because it has induced people, it has taken liquidity, and now we want to go up. You don't understand. I'll take it again. See, new structure. Now, after new structure, of course, here we can confidently say that this is a structure, right? This is a structure. If the market goes above this area, we say, yes, we have a valid break of structure. What makes the break of structure valid? Because there was an inducement. There was an inducement. So everything here is just one leg. It's no break of structures. This is one leg. The only thing that makes it valid for you to say, yes, this is a valid swing, is that liquidity must have been swept. A pullback that made a new low. We got to the new low, liquidity was swept, and market is going to a new high. Again, I'll take it. Pullback, new high. Are you seeing it? What does it look like? It looks like what? Break of structure. It's not. It's an inducement. Okay, it's an inducement. It can happen several times. If it happens again, it's an inducement, guys. It's an inducement. What the market is saying is use the POI here, use the POI here, use the POI here. I'm going to take all of them. The first one is called what? The first pullback. When this thing starts to go backwards, the first one is called what? Inducement. The second one is called what? Engineering liquidity, because it's the extreme one. If we have another one in between, it still makes this guy engineering liquidity. This one is just there for their sake, right? The two extreme ones are the main ones. So I have this guy here as the extreme one. I mean, as the first pullback, right? And then this as the extreme one. If I have to, I like to take the extreme one. Okay. You can take an entry here if you see, a change of character on the lower time frame, which will often be there. But your trade management has to be meticulous, because you know that there's an engineering liquidity, and the market may well react from the first pullback, come all the way down, take away all the stops from the engineering liquidity before it gives a new high. Take note of these things, guys. I'm going to open the chart. You're going to see wonders. So this is first one, engineering liquidity. Second one, maybe there. Third one, maybe there. Then let the third one be the last one. Then we call this third one what? The inducement. Induces people, engineering liquidity. So this one induces people, this one engineers the liquidity, and then they go. They make a new high. So you're never ever going to see me take an entry off of, you see this thing I've been showing you since, this. I'm never ever going to try to take an entry here unless I see that people were induced or that there was an engineering liquidity. If I don't see engineering liquidity, inducement, I'm not going to come here to look for entry. I hope you're learning good. So I'm not going to be able to finish, okay, because it's already time for me to close the class. So, but just to take you into the market really briefly, I'm going to, I don't know if you have any particular market you might like me to look at. Let me see. Let's take EU. Or let's look at GU, right? Let's look at GU. So I'm just going to show you, this is what time frame. This is weekly. So let's go to H4, right? So I want you to see as much as you can here. So now there's something that I need to tell you. If you want to read the tapes, so there are some things that are easy, that are very, very easy to see. Okay. And if you have difficulties with seeing it, just switch your chart from the candlesticks to line, right? Candlestick to line. You see all the lines I've been drawing since. They are here. Okay, the market will push down, will go up, come back down, tap into the engineering liquidity here. I mean the first liquidity that is here, and then it will come down. What happens again? It goes back. It comes again. It goes back. It comes. This is exactly what I've been showing you since, right? And then what do you have here? Change of character. Change of character, what happens? Come back down here. You join them, you buy new high. come back down here, you join them, you buy new high, come back down here, you wait for what? Change of character. Where are you going to find change of character? At the area here where you have the previous swing. Once the character changes, what you want to do, you want to look for opportunities to sell. Okay, so this is just an example, right? This is just an example because this is obviously not selling. Okay, I'm just using that as an example. So again here, look here, you have, let's say you have trend going down, you buy here, you sell, you sell here, you sell at this point, you come back here, market does what? Change of character. By the time it gets to this point, you have change of character here, and then you go, what do? You wait for the pullback, you join the pullback, you go up, market goes that way, and then you come back like that. Now this is the rough view. I'm just showing you because I've been using lines and lines and lines and not candles. So now I'm going to show you a couple of things using the candles. Okay, so you can you get the idea, right? So just look at the lines, right? Look at the line. This is the price. Okay, this is the price. You can see what it's doing. It's just going up and down, going up, going down. You know. So all you're looking for is you go to your lower time frame at the high area. See if you have a change of character, and then try to sell. Sell where? To the base, the area of the low, and then join them to go up, right? Join them to go up, and then see what I told you. See, I want to see a pullback that is taken. I want to see a pullback taken. If a pullback is not taken, I'm not going to try to buy, right? Pullback taken here, pullback taken here. You can see what was taken here. See, this is what first one, inducement. People try to buy here, right? People try to buy here. Okay. Second one, what? Engineering liquidity. Once the engineering liquidity is taken, I'm ready to join, right? I'm ready to join for a new high. Okay, again, what? Liquidity, right? Liquidity. What? Liquidity. Okay, market takes this one, takes this one, takes these two, this one here, takes them with what? With this area, and it goes to a new high. That's the same thing market does over and over, over and over. Liquidity, liquidity. What does the market do? It comes back down, takes one liquidity, takes second liquidity, and goes where? To a new high. Again, liquidity, 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 liquidity. What does the market do? Come back down here, take all the liquidity, all the stop losses. The people who think that they're gonna this is break of structure, this is another break of structure, this is another break of structure, it will stop all of them out and go high again and again and again. That's what the market keep doing again and again and again. You're going to have to be on the lookout for the next video because I'm going to take you a step further. I'm going to teach you how to read this tape step by step, step by step. You're going to know where you're supposed to go in and where you're getting induced. I see a lot of people say inducement is a pullback. That's gibberish. That's total nonsense. You can't use it to make money. You say that, and then you come back and say it's optional. Inducement is not optional. Inducement has to be there. Inducement has to be there. You crazy or what? Inducement has to be there. If inducement is not there, how are you going to know that people are trapped? Or what is going to provide money for you to make your own money? Inducement is supposed to be there. Right? Because I see all these people who have all this educational thing, they put up a lot of videos. You see 1,001 videos on the YouTube. And then they're just teaching because they want to teach and they want to try to get people into their space. Right? They're not teaching good. Okay? Or at least I would say they don't know what they're teaching. Okay, so you really have to look out for that video because like I said, I can't teach everything in one class. It takes some people months to get their head around what I'm trying to teach you here. Okay, so but if you follow what I'm doing, in a short time, you're going to get it. It's not difficult. It's not difficult. What I want you to do as your assignment is go into the chart, look for the major structure, which is the swing structure. Look for the minor structure, look for the substructure, and then show them to me, right? So label them, okay? Label them and show them to me. I want to see something like that, okay? Because I want to see if you understand at least the first part. Then I'll take you a step further because in the next area, In the next area, what I'm going to be showing you is I'm going to be labeling the swings for you one by one, so that you know whether this is an inducement or it's actually a it's actually whether it's an inducement or it's actually a new leg that you should be anticipating is a sell from or a buy from in this case, right? Is this is this a swing or is this an inducement? Which one is an inducement? Which one is it? Some people say 50% pullback. Some people say weak. Some people say body close. Some people say this. That's rubbish. This is rubbish. There is a way. We need to read the movement, the liquidity. How is the money going? That's what we're going to tell you if actually that place is valid. Don't say this is what you use, that is what you use. There are only three things. The only three things I'm going to teach you now in the next video. The only three things that the inducement is taking or the engineering liquidity is taking. That's what's going to validate that swing. That's number one. Number two, at least a 40% pullback. At least a 40% pullback. At least a 40% pullback from the previous swing. A 40% pullback at least. Then number three, you're going to compare all the pullbacks that are going on. If you see a pullback that is a new pullback that is deeper than the ones that have been happening before, then that is a swing. So you need to wait and look at the other video. So just be on the lookout. I think that's all I can say. Be on the lookout, because if you understand just a couple of things, right? Especially with market structure, it's going to help you. Going to help you go a long way. You're going to be way head and shoulders above every other person, right? And then you know what to buy, you know what to sell. You stop buying at the top, at the height of the move, right? You stop buying at the height of the move. Right, you join with the smart guys. You see, once the liquidity is taken, you're right here, you're waiting to join. Why? Because you understand that the market is going to go up now. It has accomplished its mission. It's going to go up. You join. You know when to join. I'm going to stop the class here. Thank you so much, guys, for joining me. Unfortunately, I will not be taking any questions. If I'm going to take any questions, I'll just take from some of the students in my mentorship. If I find any, how do you calculate the 40% pullback? You use the tool called the Fibonacci, right? If I want to check if there's a 40% pullback, I will use the Fibonacci tool, and then I'm going to go like this. It's a Fibonacci tool, right? So it's a tool. I'm sure you're still pretty much, you just joined. I don't think I've had any mentorship session with you yet. This is from Kofi. I haven't had any session with you. So just wait. I'll show you more, right? This is a Fibonacci tool, right? These are the very basics, okay? So I'll take you over there. I have, okay, just wait until the next class. Okay, I would just have to end everything here now. Thank you so much, guys. So I really want to encourage you guys, go back to your charts. I always say that many of you want to make money. You want to make money like Ronaldo, like Messi and the rest of them, but you can't even spend a minute here. You can't spend a minute here. You're busy. You are lazy doing nothing. You want to make millions of dollars. Then we say, okay, this is how you can make millions of dollars guaranteed. But you're not willing to put in the work. What do you think is going to happen to a player if he doesn't come to training? Midweek training, he doesn't come to midweek training. You think they're going to let him play on Saturday? No. On Saturday evening, he's going to be on the bench. So open your chart. Everything you're looking for is inside the chart. It's inside the chart. All right? And I always encourage you, as long as your coach is doing the right thing, you stick with him. There's nothing wrong with having many coaches. You can have a coach who's working on this, you can have a coach who's working on that, and that, and that, and that, right? So, but you have to do the investment. If you don't have the money, that's why I have the free channel. I have all these things I teach for free. I don't care about your money, right? But I mean, the guys who are in here have paid. Okay, so, and I know that when you pay money, you're going to get serious. You're going to get really serious. If I tell you do something, you're going to do it, right? So, if you, I don't know if I did not add any link whatsoever to this video. I'm going to try to do that maybe later, but I'm sure that many of you know how to reach out to me. Okay. You know how to reach out to me. If you want to reach out to me, you can. If you're serious about your trading career, you really want to make money from trading, you can get away from the free stuff, right? Come in and then let's do the serious things, okay? And then let's go, every day, let's keep grinding until we get what we're looking for, okay, which is the payout. All right, thank you so much, guys, for your time. It's always a pleasure to be with you here. I appreciate every minute that you spend here. I'm sorry that it had to take a long time. I'm always trying to get the details, the little things, trying to teach all those little things to make them at least a little bit clear. Okay, so thank you so much for being with me today. Those of you who are here up to now, you are the real MVPs. Thank you so much for your time. Do have a lovely rest of the weekend and a wonderful, fruitful, profit-filled, no SLs week ahead. God bless you guys.